Welcome to the deep dive. Today, we're moving past the day-to-day price noise. We're really cracking open the strategy book for Galaxy Digital,
Yeah, it's a fascinating moment for them, a really big, deliberate shift.
moving away from just relying on the ups and downs of trading towards something more solid.
Exactly, towards long-term stability, almost like a utility company in a way.
So our mission here is to unpack this two-pronged approach they have. First up, there's this big goal, $40 million in annual recurring revenue.
A hefty number.
And second, how that goal, plus this, frankly, surprising move into physical infrastructure, really signals something bigger about the whole digital asset space maturing.
It's definitely a critical discussion
Yeah.
because this isn't just like a quarterly plan. It feels more evolutionary.
Hmm.
We're seeing a major player trying to transform itself, moving from riding that speculative wave.
Which they were very good at, let's be honest.
Oh, absolutely. But moving from that to becoming, well, almost a boring, essential infrastructure provider.
Boring is good in finance sometimes.
Oh.
Predictable.
Predictable is where the smart money wants to be long term. That's the signal here.
And that dual focus is really the hook, isn't it? On one hand, you've got this push for predictable fees, sticky income from managing digital assets for others.
High-touch treasury management, yeah.
And on the other hand, they're sinking real capital into actual data centers.
Yeah.
For mining, sure, but also AI processing.
Exactly. That's the combo. The lesson from the last few crypto winters seems clear. Build resilience. You need diverse, non-speculative income if you want the big institutions to trust you.
Okay, let's dig into that first pillar then, the $40 million target. For you listening, what exactly are these digital asset treasury mandates that this number hinges on?
Right. So a treasury mandate is basically when a large entity, think a corporation, an institutional fund, maybe even another crypto firm, decides, hey, managing our crypto assets is complicated.
The compliance, the security.
All of it. So they outsource it. They hand over their crypto holdings, often significant amounts of Bitcoin or stablecoins, to Galaxy's asset management division.
And Galaxy doesn't just hold it, right? This isn't just cold storage.
No, it's active management, but within strict institutional guidelines. Secure custody is baseline, of course.
Right.
But then you add things like sophisticated hedging using derivatives,
Okay.
and crucially, staking and yield generation strategies. But, and this is key, tailored specifically for clients who are very risk-averse and need everything buttoned up from a compliance perspective.
That brings up a really important point, though. Staking, yield farming, historically, that's where things got risky in crypto.
Yeah.
Counterparty blowups, protocol hacks. How does Galaxy make that palatable for conservative institutions?
Yeah, de-risking is absolutely job number one. It comes down to structure. We're talking about things like fully segregated client accounts so assets aren't commingled,
Right.
transparent on-chain governance where possible, using only regulated platforms or their own highly controlled systems to minimize that third-party smart contract risk you mentioned.
So the fees they charge are partly a premium for taking on that operational burden and guaranteeing compliance.
Precisely. It's a premium for peace of mind, for knowing custody is institutional grade, and the regulatory I's are dotted and crossed. That's what traditional finance demands.
Okay, I get the parallel now. It's like a big company hiring, say, BlackRock or Fidelity
Right.
to manage its cash reserves. It's less about chasing crazy returns
Right.
and more about reliable, safe management and ticking all the regulatory boxes.
That's the perfect analogy, and that's why it signals institutional stability. When Galaxy can stand up and say, we have $40 million in predictable recurring fee income, it just fundamentally changes how the firm is perceived.
It decouples them somewhat from market swings.
Exactly. Volatility becomes less defining. It shows a stable, fee-based business engine, which is exactly what long-term investors want to see. That $40 million could, cover a big chunk of their fixed costs, showing real strength, whatever the market's doing.
And we know this is mainly coming from their asset management arm, which, to be fair, already manages billions in assets under management, or AUM. But isn't there a potential conflict? Galaxy also runs a huge trading desk. How do they assure clients that the asset management side is truly separate, that client interests always come first?
That's a classic question and crucial. It's managed through what traditional finance calls Chinese walls, strict internal controls, legal barriers, operational separation.
Okay.
The client funds and asset management have to be demonstrably separate from the firm's own proprietary trading activities. It's a regulatory necessity, but also critical for trust.
And the fact they are winning these mandates suggests institutions are getting comfortable with that separation.
It suggests they're satisfied, yeah. Likely involves external audits, regulatory oversight confirming those walls are solid. That level of institutional buy-in is what makes achieving that $40 million target so significant. It validates the model. Okay, so let's shift gears from the financial side to the physical side. The second pillar, this vertical integration through the Helios infrastructure build-out.
Right, Helios, their massive data center in Texas. They picked that up from Core Scientific, didn't they? Back in the depths of the 2023 bear market.
They did. It looked like a classic contrarian, maybe even vulture play at the time, buying distressed assets.
Definitely raised some eyebrows.
But the expansion they're doing now shows it was more strategic than just bottom fishing. They were securing fundamental compute capacity for the long haul.
And this is where it gets really interesting, because you said it's dual purpose. It boosts their Bitcoin mining, obviously.
Significantly boosts their self-mining capacity, yes.
But it's also being set up for AI.
That's the sophisticated part. They're engineering the expansion to handle not just mining rigs, but the incredibly power-hungry, high-density demands of AI processing.
Okay, hold on. What's the actual difference there? Why can't any mining data center just run AI workloads? Is it just about drawing more power?
It's more about density and cooling, which leads to pretty big engineering challenges. Bitcoin mining uses a lot of power, sure, but the compute is sort of uniform. AI, especially training these huge language models, needs racks packed tight with specialized chips, think NVIDIA H100s or similar GPUs.
Which throw off immense heat.
Exactly, massive heat loads. So to handle that effectively, Galaxy is building out for things like liquid cooling systems. That requires different kinds of racking, specialized high-voltage power setups, super low-latency networking, stuff your standard air-cooled mining shed might not have.
Got it. So this is where that convergence narrative really comes into play. They're building the physical layer to serve both blockchain and AI.
That seems to be the strategic prize. Build flexible, high-power infrastructure, and you massively diversify your revenue. If Bitcoin mining margins get squeezed,
Which they inevitably do sometimes.
they can pivot that capacity, lease it out for AI compute, and earn those nice, stable infrastructure as a service type fees. It's a hedge. We're seeing competitors like Marathon Digital, Hut 8 making similar noises about AI compute too. They realize the heavy lifting done for mining power infrastructure is transferable.
And expanding Helios also helps Bitcoin itself, right? By supporting Galaxy's own mining, it adds to the network's hash rate and security.
It does. It further embeds them into the foundational layer of Bitcoin. It really shows their commitment to being this vertically integrated player. They want to touch everything from managing the asset
And asset management.
to securing the network itself through their mining infrastructure, controlling more of that whole stack.
That really clarifies the macro picture. Which leads nicely to the why now question. Why are big institutions suddenly getting comfortable outsourcing these critical, sensitive digital operations to firms like Galaxy or Coinbase Custody or Anchorage? What changed?
I think it's a mix of risk and opportunity converging. You've had uncertainty from the Federal Reserve pushing institutions to look harder at non-correlated assets like Bitcoin.
Yeah.
And the previous crypto crashes, ironically, gave them opportunities to accumulate assets more quietly, maybe at lower prices. But actually managing those assets internally, that's a whole different beast.
Huge operational lift. Legal, compliance, tech headaches.
Exactly. So these Treasury mandates become a way to outsource that operational risk, and importantly, the regulatory risk.
So it's risk mitigation as much as anything.
Precisely. Institutions get the potential upside of holding digital assets, but without building an entire specialized crypto division in-house. No need to hire blockchain security experts, navigate global regulations, build compliant custody tech. Galaxy handles it. It's like the institutional easy button for getting compliant crypto exposure.
Which feeds this bigger story, doesn't it? That crypto is slowly but surely moving onto corporate and fund balance sheets. Less purely speculative, more part of a structured financial strategy.
The signals for that normalization are pretty undeniable now. I mean, the BlackRock Bitcoin ETF launch was huge, symbolically.
The ultimate institutional stamp of approval in some ways.
Right. And the fact that established regulated players like Coinbase Custody are providing the underlying services for those very ETFs just shows the enormous and growing demand for this kind of structured, compliant management. Galaxy is positioning itself aggressively to capture a slice of that fee-generating pie.
So let's bring it full circle. Galaxy has these three main parts to its business: trading, asset management, and mining infrastructure.
Right.
How does this $40 million recurring revenue push really strengthen that asset management pillar within the whole structure?
It gives it weight, ballast. That predictable fee revenue from asset management becomes the stable anchor for the entire business. It provides the resilience needed to smooth out the inherent ups and downs of the trading and mining divisions.
Makes sense.
It really solidifies their pitch as a serious, sophisticated institutional partner. It demonstrates a viable path to profitability through any market cycle, which is absolutely essential if they want to compete credibly against the big legacy financial institutions entering the space.
That is a really clear synthesis. So what we've seen today is Galaxy Digital laying out a very deliberate strategy, shifting focus from chasing market volatility towards building a much more stable foundation. Recurring fees, infrastructure, sustainable business building blocks. And look, we really appreciate you joining us for this deep dive into the Galaxy Digital playbook. If you found this breakdown valuable, if you want us to keep digging into these kinds of crypto and institutional strategy stories,
Which we love doing.
absolutely, then please, take a second to subscribe, maybe drop a comment below, engage with the video. It honestly makes a huge difference. Sharing, liking, commenting it helps support the channel directly, makes us more visible in the algorithm, and that lets us keep putting in the time to bring you this kind of in-depth analysis each week.
Yeah, we really appreciate it. And maybe a final thought to leave you chewing on. If these big smart players like Galaxy are so focused right now on building out the core infrastructure, the compliant plumbing, the data centers, the fee models, does that suggest the smart money isn't just waiting for the next phase of institutional crypto adoption, but is already actively positioning itself for it, building the rails before the train fully arrives?
That really is the million-dollar or maybe billion-dollar question, isn't it? Is this $40 million revenue goal, combined with that ambitious AI and mining data center play, the clearest sign yet that institutional capital isn't just testing the waters anymore, but is actually moving all in on building out the essential crypto infrastructure for the long term? Love to hear what you think.
Thanks again for diving deep with us.
We'll catch you on the next one.